Hello everybody, and thank you for joining us today in our Prescient in Perspectives webinar, which is really a view of what happened in the first half this year, and we'll give you some insightful thoughts about what to expect from the year ahead. Today we've got a full panel, bit of a different webinar setup from our previous webinars where we usually go asset class by asset class. So full house from the right hand side. Today we've got Conway, who looks after alternatives and credit, Rupert looking after our multi-asset portfolios, Henk, cash and fixed income. On my left-hand side, we've got Reza, looks after our bonds, Bastian, our CIO, and on the equity side, we've got Siyiso. Folks, we have had an action-packed first half. I remember coming into the new year, and we spoke about, on our first set of webinars, the multi-asset webinar in particular, that macro was going to matter this year. So we've had a full 6 months. Bastian, maybe best place to start is with you. Give us a rear view look at what happened in the first half of 2024.
Thanks, Murray, and thanks everyone for joining. Particularly excited today to have a full panel and all asset classes represented. So, Murray, to your point, I guess looking back into the first 6 months of the year, I guess the key drivers have been what happened to global inflation, what happened to global growth. Those, by the way, are also the themes which we think will be definitive, what's going to happen for the next 6 months, and obviously we have to look at the reaction function of the Fed thereof. I'm going to start off speaking about global inflation. Speaking about global growth a little bit later. I guess global growth is where our story is potentially on the brink of changing a bit, but on global inflation the view is totally unchanged. So we've long said that inflation has peaked and it's on its way down, and we actually expect it to re-accelerate on its way down. We have these last 12 months of what some market participants call sticky inflation. We don't really see it as sticky. We rather think that there was a short-term interruption of the disinflationary process, but it actually continues to be well on track. And that often leads us to ask the question, why that? So the key driver is ever lower shelter inflation. So the shelter component makes up 36% of the CPI basket by now, more than 50% of the contribution of the most recent CPI prints. And we see a big drag on that shelter basket, and that's just absolutely important to understand. Inflation is very, very notoriously hard to predict, but there are certain components of inflation which we can predict quite well. So I'll use that shelter basket once again as an example. If we take a simple econometric analysis and we just use house prices, wage growth, and new rents, we can explain the shelter component with an 84% degree of accuracy. And we do get the outcome here that inflation continues its journey downwards. And that leads us to ultimately the question of what is the Fed going to do about that? We are at 5.25 to 5.5% interest rate still. Inflation is now down to 3%. And as we said, we are quite convinced that the journey downwards will continue. So the question is, how long can we keep rates at such high levels?
Bastian, thanks. Reza, I remember coming into the new year and everybody expected rates to start getting cut, but inflation, as Bastian said, looked a little bit sticky, and everybody's starting to watch the Fed and looking for the next Fed minutes, et cetera, et cetera. Give us a view on the interest rate environment, and then maybe tack onto that where we expect it to go from here.
Sure, yeah. Thanks very much, and hello to all the viewers. Thanks, Murray, for hosting us. So on the Fed, I suppose we can offer sort of two levels of analysis. The first one is just purely observational. So if we just look at market implied expectations, what we can see now is that you're talking about the Fed futures curve and the evolution thereof. There's been now one cut that's been fully discounted for September. So the market implied probability of a cut happening in September is now almost 100%. That's quite a step change from less than 50% some months or two ago. And then looking at the calendar year for 2024 as a whole, what we can see now, because of the continued progress on the disinflation process, we can see that there's now about 2.5 cuts that's now been priced in for the calendar year 2024, and that is also a little bit of a step change from the 1.5 that had been priced in about a month or two ago. But that's purely on an observational level, and I suppose that is something that our clients can sort of read off for themselves. I suppose what's far more interesting and what is top of mind is that what will the step change in the policy rate environment actually mean for the risk asset complex as a whole, and I think that's where I'd like to offer maybe a few comments, but maybe just taking a couple of steps back. I think taking a data-driven approach as we do here at Prescient, I think that if we just look at this journey that we've had from inflation at about 9% to 3%, if you look at the process quite carefully, then you can see that actually monetary policy had very little to do with that disinflation. I mean, if you think about the early days of inflation, that was very durable goods driven. That actually relied not so much on monetary policy becoming hawkish, but more a rehabilitation of the supply side of the economy, right? And that process actually worked out. Similarly, on the last mile of inflation, shelter inflation, which Basti just spoke about a moment ago, that is not that rate sensitive, simply for the simple fact that not many mortgages in the US are actually variable rate driven. So there are linkages, but if you look at the inflation progress that needs to happen now, it's not actually that monetary policy dependent. But there was one very consequential sort of ramification of this very aggressive hiking cycle that we've had. And why it's so consequential for risk assets is because what this hiking cycle has done is it's acted like a massive vacuum cleaner or massive Hoover machine for risk capital globally, right? So because you got such attractive rates in the US front end, essentially risk-free, that has been a very, very welcome home for risk capital in the past 2 years, and it's basically sucked money out of high carry emerging market destinations like South Africa. So now we're staring down the barrel of rate cuts and that process potentially unwinding. What we've also got is an okay US consumer that has run the gauntlet of this very, very aggressive hiking cycle and come out with a couple of bruises, a broken arm, but definitely not on life support. So the US consumer has actually navigated the hiking cycle. It's sort of come out okay, slowing down for sure, come out okay. And now you're looking at the prospect of rate cuts, you know. So that combination, if we follow that sort of econometrically and in a systems-driven way, can be very, very positive for risk assets going forward.
We'll come back to that, maybe a rates view. But if I turn to Henk, I mean, I think Riza makes a great point around being battered and bruised. I think in the South African context, we're pretty much broken and bent. It's been very tough because obviously from a South African perspective, we've had higher rates for longer, maybe not as necessarily so, but in an expected cutting cycle, good for the consumer domestically, freeing up some capital. But what does that mean from an investment perspective and interest rates in South Africa?
Yeah, good morning, everyone. Thanks, Murray. Great question. Thanks for the sort of opening remark, gentlemen. But yeah, very pleasingly, if you think back to what we've been saying throughout the sort of course of the first half, we've seen this sort of divergence between what was priced in the US market for interest rates and what the South African market was saying. So South Africa wasn't really priced for as deep a cutting cycle as the US was, which arguably is incorrect. But pleasingly now what we have seen, certainly with the sort of more risk on impulse, the South African market now also pricing interest rate reductions. Not quite as much as the US, but certainly in lockstep. So pleasingly, we'll see the Fed meeting before our meeting in September. And our market is also now pricing almost 100% of a rate cut in September with 0.5% to the end of this year. And then throughout the forecast period, almost 1% priced. Again, very, very good for our consumer. Front end still remains pretty elevated. So 1% from sort of 8.5%. Certainly by no means a very deep cutting cycle. We still see very elevated real yields in the front end, given sort of inflation forecast being benign, as you said, the consumer in SA being very battered. So still very attractive proposition, but certainly good news from the front end on the SA yield curve perspective.
Thanks. Riza, if we go back to sort of this whole analogy around rates, the US we've mentioned is high short-end rates, but at the back end, longer US bonds, you know, tells us a story as well. So what's the direction and how does one play that? And then maybe contrast that back to an income story from a domestic perspective, yes. Because obviously, you know, the opportunities to be buying bonds at the back end yes. in the US and South Africa look very attractive.
Sure. Yeah, so maybe just taking a step back in the local context, we've obviously just had you know, the advent of a national election, right? And basically in the month of June, it's been one of the strongest months on record for South African duration assets and in fact for assets across the fixed income spectrum here in South Africa. But
unfortunately, we've seen South Africa's foreigners coming to the South African bond market to support that.
Absolutely.
Which is great.
But just prior to the national election, and I think this is quite an interesting you know, comment to take our viewers on a journey on. I think that we'd obviously received a volley of questions from clients, from consultants, from the financial media as to how exactly will Prescient navigate the duration stance with the advent of an election coming. What do you do when the election hits? What do you do after the election? How does an optimal portfolio basically look? And luckily for us, it's the same answer for all of those questions. I mean, right? And but maybe just to take our listeners through that. I mean, what we would say is that when you are dealing with sort of local, idiosyncratically South African events, whether it's a national election, or think Nenegate, or think Lady R, or think the Ramaphosa farm scandal, any of those things, right? You can substitute any of those things. What we would say is that local idiosyncratic events can have an impact on the South African bond market, subject to two massive qualifying comments. Number one, that the effects that those local events have on the bond market are very short-lived. The second one, and much more importantly, is that when you analyze the bond market for any significant period of time, what you do find is that those local events are nothing more than statistical noise around a trend line that is really driven by global factors, right? So we really try to get a grip on global factors that actually drive the trend lines of the African bond market. And what we do notice is that from time to time you have these oscillations or these little bits of statistical noise that are actually mean revert and auto self-correct, right? And what we found quite bizarre, sitting on this side of the fence, was looking outwards, was that prior to the election you had, let's call it, some of the more fundamental houses, spending an incredible amount of man hours, debating what kind of permutations will mean what for asset prices. When in effect, based on what I've just said, effectively that's like having a debate about predicting noise, right? It's like trying to predict the outcome of a random walk. So we'd rather focus our energies on trying to get to grips with what are the long-term statistical drivers of the trend line. You're not going to be able to match every data point, but being able to basically get to grips with trying to forecast the trend line in South African bond market, or the equity market, or the credit market for that matter, trying to get that gets the odds massively on your side with regards to future outperformance. And that's really what we try to do here. So in terms of what is it saying now, based on the fact that we've already said most of the drivers are global in nature for the South African bond environment, where we are now is a little bit of a neutral stance, right? It's been quite fantastic in terms of performance, months leading up to the end of June. But how we see the situation potentially unfolding for the rest of the year is that the action will really happen in what we call our financial conditions column. So based on the comments that Bastian has made, I've made it, and Henk's made, we really see a situation of easing financial conditions, certainly financial conditions that we look at, and that potentially is a major catalyst for what we can see happening. So we at neutral duration, benchmark is duration now, but we think that we can get a lot more constructive as the year goes on, once that financial conditions pillar does start to unwind.
Okay, Risa, thanks for that. Bastian, the big important driver around markets and the direction of expected returns is the global growth story. And I think with high interest rates, what you'd expected is that you'd have seen global growth slowing. Maybe just a comment on the global macro story from a growth perspective. Where do we see that in the US? Europe also and then, it's important to understand that. Maybe move from left to right from a global perspective and even talk about the South African context.
Yeah, sure. I mean, if we start, we spoke a lot about inflation now, and I guess our story is pretty unchanged there. We said, inflation is going to come down, potentially come down quicker than what market participants anticipated, certainly coming down quicker than market participants priced the Fed to move. So with that, all positive on the inflation front. On the global growth front, interestingly, that's the one area where our view might potentially change a little bit. So for 1.5 years now, we have been very positive on global growth, driven by our information which we get out of the Prescient economic indicator. So the Prescient economic indicator, our in-house nowcasting tool, told us, don't worry about the discussion around a hard landing, a soft landing. There will be no landing because the data doesn't support any deeper recession or any softer recession at all. And that's exactly how we positioned the funds, and I think we've done well by doing it. What is changing now is that we are seeing quite a bit of a slowdown in the Prescient economic indicator. So basically, in real time, the global economic data starts to suggest that there's a little bit more of a slowdown coming than what we've seen over the last couple of months. Again, no recession, but a more pronounced slowdown. And now the question is, where does that stem from? So over the last, I think, 1.5 years, again, we always had a little bit of headwinds from economic factors or economic conditions, from industrial production, from the business sector, et cetera, et cetera. So what really kept the US economy, and with that the global economy strong, was a very strong US consumer, which Riza already mentioned earlier. And that kind of like still is the only leg of the US economy to stand on, but the headwinds there are really forcing, and it starts all with the US labor market, which continues to be reasonably strong, but the more forward-looking labor market metrics are starting to deteriorate. So if we just look at the unemployment rate, it's at 4.1% now. You can say that's still very low, but we're coming from 3.4, and these cycles turn slowly. If we look at a broader unemployment measure, like the U6 unemployment, we've moved from 6.5 to 7.5. So we are trending higher. And more importantly, if we look at broader labor market conditions, they are starting to weakening as well. If we look at more forward-looking labor market metrics like the hiring rate or job openings, etc., they're all coming down. Wage growth basically coming down sharply. So with that, stronger labor market now really starting to become a drag. And with that, now we all have to look at the consumer. How long can the consumer be strong? Forward-looking metrics on the consumer are consumer confidence. And consumer confidence has been very strong up until now. So the last survey from the University of Michigan actually surprised significantly on the downside. And that's what basically raised a lot of caution. So we're not there yet, but potentially the theme for the second half of the year is definitely to react to ever slower growth in the States. And as I said earlier, there's self-reinforcing cycles ongoing. So if the economy slows above or below a certain level, then often you reach stall speed, and then eventually you do drop into a recession. Absolutely not what we track now, but something to be looking at very, very cautiously.
Okay, thank you. So I guess the high interest rate environment it's kind of, the Fed has engineered what it wants it to do, but now we're seeing the slowdown, which impacts everybody around the world, whether it's imports and exports to and from the US, but obviously positioning portfolios around this. So you've got to take heed of what direction, whether it's equities, bonds. From a multi-asset point of view, I guess this has been quite tricky. So maybe Rupert, just turning to a multi-asset view, given what we said around rates and certainly long rates, how have you, the first half, how did things play out for you in the multi-asset world?
Thanks for having me this morning. So I think to focus first on the first half, we had a great first half given the changes in expectations. So we've had yields coming in, which impacted pretty much every building block within multi-asset in a positive way. We had the rand strengthening, which also impacted the multi-asset portfolios in a positive way. We have that 45% offshore, but we hedged back around half of that. I think that's what hurt a lot of our peers. They took the risk off the table of South Africa. They diversified it overseas, which is exactly what you want to do. But then they had massive exposure to the rand, and the rand strengthened post the election results, and that really hurt the peer group. So we've done well on that. We've had positioning longer duration in line with Riza and the bonds team's view, which in turn benefited funds when yields came in. But I think that it is important to focus on what Bastian was talking around, which is global growth. So global growth has come in, has moderated, let's say that, slightly, which means that we were at a stage neutral on global equities. We have now shifted to being underweight on global equities. And the reason for that is that you've got a global equity market which is at PE ratios near all-time highs, a massive, massive rally in global equities, especially in US tech stocks. And that was to a degree supported by a positive growth outlook. So no recession, no hard landing, a positive growth outlook for the future. But that has changed towards not going to say a recession, but towards a moderating or a slightly slower economy in the United States. And the tech sector in particular in the United States is essentially a geared play on equity markets. So for that reason, we are now underweight in the US and global equity space. We don't see much value in Europe either. But I think it's important then to bring it back into the South African context, because more than half of the multi-asset portfolios are based in South African asset classes. And I don't say this every time, but genuinely every single person in this room is offering, or every team, every strategy in this room is offering something very attractive right now in South African assets. So we've got bonds near all-time highs. They have come in, but they're still pretty high yielding. Income, really great running yields right now. Credit, extremely high yields within the credit space. And then SA equities, not to finish last with SA equities, but SA equities, I finished last on purpose. It's actually probably one of the most interesting asset classes to talk about, because we've got a very, very undervalued SA equity market, and it's been arguably undervalued for a long time for the right reasons, because of uncertainty. And that's what every asset prices in, is uncertainty. But now that we've got this government of national unity coming through and pro-growth policies for South African growth-based assets, it's not just the fixed income asset classes that are looking attractive, there's also opportunity within SA growth assets.
Yeah, so just on that, if we think about global equities and what's happened over the first half of the year, it's really been a half of 2 quarters. And I'd like to break it down into what we've seen in developed market equities, emerging market equities, and then, as Rupert was saying, bring it back to local equities. So in the developed markets, we had quite a strong run into the back end of 2023. We've seen that continue into Q1 2024. Again, mostly driven by this tech AI theme, and also, as was said before, strong consumer. We saw earnings come through quite strong during Q1, and that has led to this run in global developed market equities. If you look at the MSCI World Index, for instance, that's up over the first half of 2024, somewhere in the region of 12%. A lot of that is from the US. Again, the US being over 70% of that index, and with the S&P up 16%, you can sort of see why. And then if you look at emerging markets, for instance, that's been, started off quite shaky, particularly with the issues in Asia. But we've seen a big bounce back over the second half of the second quarter of 2024, and that's been mainly due to China, that state-sponsored support filtering through. But we've also seen markets like Taiwan, we've seen markets like Indonesia and India coming through. And then bringing it locally, we started off actually in negative territory. And as you said, Rupert, we've seen this massive rally on the back of that uncertainty dissipation from the elections. And what we're now left with is great valuations in the SA equity market. If you look at just earnings multiple, for instance, traditional valuation metric, you can see that the SA equity market is actually sitting at around half the valuations that the developed markets are going for. So really great value. And of course, valuation is not the only metric that we consider, but if you're simply to consider it from that perspective, then this is actually a really good time to be considering local equity markets.
Cecil, thanks. I think linked to that is this whole story around positiveness around the country. The expectation that you have interest rates obviously being cut is important for us. I mean, the reflection or the next step out for me has always been the credit markets, which are largely linked to corporate South Africa. So, Conway, if we bring you in here around the credit markets and what you see, I think this has been an important asset class, certainly in the fixed income space. And maybe you can comment on what we've seen over the first half. And given the expectation that corporate South Africa is in a good state, you've got positive business sentiment coming in. I mean, this should be really good for credit markets.
Yeah, so hi, good morning everyone. So I think the first part is that everyone's vying for capital. So it's quite ironic that I go first because credit's always seen as the stepchild of the entire market, right? Spreads are at all-time lows, risk is at all-time highs. Why are you even investing in this space? So I think just to start off, it's a really great place to be investing right now. JIBAR at current levels, just think of it, irrespective of what spreads are doing, you're still getting a decent return across the curve. So even if you're competing for govies or you're competing on the front end, if you do credit right, and that is what we believe we do, if you do credit right, there is definitely a space for it. And the performance of, for example, our Income Plus fund, which is our flagship credit fund, which all of my peers across the table here are actually invested in, is showing that with those returns and a moderate level of risk, you can actually achieve great things. And so what my team has been doing quite a bit is firstly forecasting what's going to be happening in the market from an issuance perspective. Because what we have seen is that issuance, auctions, those sort of trading, that drives spreads as opposed to what's actually working from an economic perspective. So the more that's issued, there's more that's available for everyone to actually participate in, the actual better for spreads, but that's not happening. So for example, in the first half of the year, there was about 80 billion in issuance, of which only 69 billion was refied. So that has actually been a drag on the market. The market has actually contracted. So again, a smaller market, again, as opposed to economics driving spreads, it's the lack of supply actually pushing spreads down. And then you still have elevated levels of default risk. So that's the first part of what we try to look at. And then the second part is just at the volatility within the underlying sector. So again, stepchild because there's no mark to market. There's all of these liquidity considerations that's really driving people to stay away from credit. So what we then do is a lot of research to show, yes, volatility is very, very low in this space, but if you actually have a specific allocation, whether it is 5% for our income funds or 3% for bonds or actual 15% for our multi-asset, what that can actually bring to your portfolio in a measured manner while being able to actually provide liquidity within the asset class. And that is what we've done a lot of work on. And what we have seen is that actual secondary market activity has picked up, despite the fact that there hasn't been any issuance. So we're able to provide all of those sort of research factors to show why every single asset class should be investing in credit. And that's what we've done for quite some time. And the performance of the fund and in the contribution to the different funds has actually been quite important. The second part then is what is happening for default probabilities. And I think you touched on a very, very important part. A lot of desktop analysis out there right now is showing stay away from credit because there's so many headwinds. Importantly, if you just look at the balance sheet and you actually dig into balance sheets of corporate South Africa, you see cash is at an all-time high. We're seeing it at almost 26% of every balance sheet is represented in cash. So that top tier of corporate South Africa is the default probabilities. They are actually just flatlining irrespective of what's happening from a headwind perspective. And then now confidence is coming through, and we're talking what Henk and Riza just mentioned. If we're in a position where we actually have rates coming down, that's going to give a little bit more breathing room to corporate South Africa. That is already in quite a healthy position. But again, we have to always highlight risk. Top portion of corporate South Africa, irrespective of the return requirements and the likes, looking quite healthy in our view. But in that second tier of corporate South Africa is where we are believing there's a lot of risk, where that actual input of higher rates has actually now started to come through, and we do see increasing default probabilities in that space. So the team does a lot of work to actually stratify the actual where you should be investing in, what you should be investing in, and then how that will look on a forward-looking view.
Thanks, Conway. Cecil, if I go back to you from a positive story, I mean, South African equities from a valuation perspective, by all accounts, are looking great. What do you expect for the year ahead or the balance of 24?
Yeah, great question. So we've actually taken a systematic look at these valuations and what could potentially come from such valuations. And what we did is we simplistically just looked at in the last 20 years, recent history of the JSE All Share Index, how often have we seen, or as the index traded at these multiples, and then looked at the subsequent forward returns. And what we've seen is that there's been 5 distinct periods where we've seen these levels of valuation. So it's not quite a once in a decade opportunity, but it's quite attractive. And those were around 2005, then during the great financial crisis, 2008, 2009, a little bit in 2011 and 2012. And if the positive story here for investors is that if you look at the forward subsequent realized returns over any measurement period from those periods, it's all positive. So you have this natural negative relationship between earnings multiples and subsequent realized returns. That's just intuitive and what you would expect. But the great thing is that at these levels, what you see going forward is nothing short of double-digit realized returns. So, I mean, on that basis, I don't want to promise double-digit realized returns in the equity markets. And, as said before, valuations are only just one level, one metric that we consider. But just based off of that, these are levels that have historically and quite intuitively delivered strong growth. So you take that and you balance it out with the fact that we've had this risk event and all the uncertainty behind it dissipating. We're moving into what is surely now a monetary policy easing environment, which will be positive for risk assets. Then yeah, it's looking really positive for equities, particularly at these valuations.
Thanks. I mean, I think what we're really saying is, if you're looking to the second half of the year, the opportunities for investors to make money, certainly the South African equity valuation looks compelling, and history tells us if you invested in South African equities, you're going to do well. So I guess there's a couple of choices here from a domestic allocation point of view. There's also in a balanced fund, I guess if you've got, again, quite a healthy allocation to South African equities. But Henk, if I bring you in here, what we've seen certainly from the South African investors, they wanted to externalize money. And I guess from an expensiveness or the not being so cheap, equity allocations offshore have probably been a bit muted. So money would go offshore, sell rands, buy dollars, for example. But what's interesting is that, of late, we've seen quite an opportunity set growing in the global fixed income space. Maybe talk about our global income provider, because I think while those US rates still remain higher and you've got the equity market uncertainty, people are still going to seek out a return better than cash. And the global income provider is a great space for that. So maybe talk about how you find return in that end of the market.
Yeah, I think lots has been said about the sort of very elevated front end of the global yield curve, specifically thinking about the US. And what we have seen is a lot of SA investors going offshore and basically parking the money in, say, bank accounts, right? The question is, how can we exploit that opportunity in a sort of systematic, prescient way? Not really wanting to pick sort of single name credit accounts is not what we believe in. We believe in asset allocation. And what we've traditionally done, we do run a product called the Global Income Provider portfolio, was more focused on SA names, so SA credit names that we have a strong view, thanks to Conway and Cree and team, that has issuance in the offshore market. Okay, but the way the market has changed in the rise and sort of use of ETFs, the ability of portfolio managers to get exposure to asset classes globally and not single name opportunities, it's given us the opportunity now to have views on these asset classes, play into our strengths by taking opportunities in these, and now build a portfolio fully globalized, fully diversified in the global space by using ETFs like floating rate bonds or high yield credit type names globally, or short duration high yield, or ultra short investment grade, etc., etc. There's 23 different ones we think about. It represents about 15,000 different underlying issuance, very liquid, very cheap, and using a systematic approach, thinking about risk and return, using our forward expected returns for the asset classes with sort of historic risk numbers. We've now been able to put together a very, very smart solution for our clients in that space, currently yielding around 6.5 in dollars, very low duration, very front-end focused. And counterintuitively, we actually think it's quite a good space still, even with rates expected to come down, for you to exploit that sort of opportunity in the front end of the yield curve, be it from a cover asset perspective in the global space, be it an allocation in global balance type portfolios, and certainly investors that have diversified offshore, to get exposure to a very low risk, well-diversified, high-yielding dollar exposure.
So I think the point you make there is to re-emphasize is that even though when you start to see interest rates being cut in the US, it isn't necessarily the call to move away from a global income portfolio, because clients have gone there for a specific reason, maybe it's just to be defensive or for income, and you will still get return because the flexibility of that portfolio can look broadly around the fixed income markets.
Yeah, if you think about the global yield curve, and that's exactly that, currently very much inverted. If they start cutting rates, you should start seeing term premium come back, and the portfolio, the process we run, has the ability to then adjust and again deliver the sort of CPI plus US CPI type returns that we're looking for in that space.
Great, thank you. Rupert, maybe just from a global balance point of view, reflect on the opportunity set that you see. Maybe there's a conversation around both the fixed income and the equity opportunities. How do you put that all together in a global balanced portfolio?
Yeah, so as with anything at Prescient, we're backed by fixed income. That's the primary building block or the primary driver of active alpha within our portfolios. So what Henk was talking towards in a global balanced or global fixed income solution, we leverage off in the global balanced fund. Same process. We're looking to take on risk only when risk is warranted, right? When risk is rewarded through yield profiles. And just going back to Henk's point on 6.5% in global income assets right now. So as a South African investor, which we have South African funds which buy into these global asset classes. You add on 4% roughly for the depreciation in the rand, you're getting 10.5%. Very, very safe global fixed income asset classes. So that's very attractive as an investor with a global mandate. It's also very attractive for an investor with a South African mandate investing into global asset classes. I think just to bring it back to South Africa again, if I can, we've also got very high profiles within our Clean Energy and Infrastructure Fund, which we use within our Balanced Opportunity and our Defensive Fund offering. And those, I think, perhaps best Conway to go into a bit more detail, but we use those as cornerstones within our multi-asset portfolios.
So Conway, on the back of that, what's happening in the alternative space in South Africa?
So I think there's been a couple of big announcements. Firstly, it's a very long space. You have to be very, very patient. But there's been a couple of announcements, obviously, after GNU. Especially important is the splitting of mineral and resources with energy power. I think key for us there is that, like I was just at AEF in Barcelona, that's Africa Energy Forum. There's a lot of private sector capital waiting to deploy. So now we need to understand, does the splitting actually facilitate or push ahead renewables or not? Which direction does South Africa take in terms of the IRP, the Integrated Resource Plan? There's a lot of question marks and uncertainty, but I think the one positive that we take of this whole change or the split is that we know now there's a focused house looking at renewable energy, clean energy, and also the infrastructure space, because we know that infrastructure is the backbone of the South African economy. If you can't ship anything by the ports, Sanral can't do their job, all of the underlying infrastructure players can't do what's needed, then what we are talking about from a bond, multi-asset, global is sort of secondary, right? So very excited about what could happen. I think there's a lot of risks in terms of changes that we have to be cognizant of, but also we need to know that we've got a large foreign investor base in South Africa. So any sort of immediate changes or shock changes would result in a counter effect of what we actually want, fleeing of capital. So we do believe that there will be certainty provided, and there has been certainty to date provided. But in terms of the actual new rounds, in terms of REAP, in terms of the massive pipeline of infrastructure assets that we were told and promised, and we've been promised for the last decade, there's still a lot of work to be done. But the important part is that the private sector is there to actually step in and facilitate. We do know, and Reza can talk to this much better than me, that we've got a fiscus that can't support all of our developmental needs. But the private sector has capital available. And that what we've seen through the REAP projects and through other infrastructure investments to date is that the private sector will come to the party and will deliver, and probably deliver in a manner that's better than the fiscus can. So, sort of conservatively excited, if that is a term or a word, but a strong view that there won't be knee-jerk reactions because of GNU.
Just to use your term, exciting. I mean, I think what's happening in this country from a reform perspective, everything seems to be on track. Interest rates start to coming down slowly. I think very exciting what we've spoken about is additional sources of return for our portfolios. I mean, Rupert speaks about balanced funds, global balanced as well, huge opportunities. Henk's covered the fact that we've got access to way more instruments, and obviously assessing that is important for us from a systematic house point of view. Lots of data to assess these assets and put them into portfolio use for opportunities to deliver returns. So if it's in the credit space, global balanced, domestic balanced, broadly fixed income, local and offshore, Reza taking a duration stance from domestic and in our international portfolios. And so importantly, not to forget, obviously there's a huge equity component in all of this, and to be able to take the opportunities that we can from an equity fund allocation. Again, whether that's in a domestic equity, for example, Prescient equity fund, or even our global equity portfolios. I mean, Bastian, this talks to our systematic approach and the use of large data sets to analyze all of this and put into portfolios and optimize for the right outcomes from a return and risk perspective. I think there's also points around the innovation or what's going to be driving the market. So maybe as we start to close this webinar, just talk a little bit about the innovation that we're seeing in this AI-driven world that we're certainly involved in, and it's probably still the start. We've seen lots of stuff happening this year, but it's been very exciting. Maybe just some sort of closing comments on all of this from you.
Yeah, sure. I mean, definitely exciting times, I guess, which we live in. And I think over the last couple of months, if not years. We've seen a lot of innovation in that space, which is just outright positive everywhere. I mean, we obviously, if we want to be negative and look into individual shares, you could potentially say that certain elements of the US tech sector look a little bit bubbly, and potentially that individual share valuations have gone potentially further than where they should have gone. But that's really now nitpicky, looking at the negatives if I can find them. I think what we think at Prescient generally is that the story is positive on AI, machine learning, etc. It's just benefiting the consumer. Inflation is going to be lower because of the rise of productivity, which we can achieve through that. It's going to help us to achieve more global growth, and it's going to help us to have less global inflation. So we see all of that positive. We also think it's positive from an investor's point of view, because profit margins can be higher. When we had the spike in inflation, a lot of surprise was attached to the fact that profit margins still were so high despite wage growth actually going up and up and up. And we think that a lot of the answers to that lies in the increase of productivity driven by these quite smart, innovative trends around AI, machine learning, etc. So we do think it's throughout positive, whichever way one looks at it. And obviously at Prescient we are smiling because it's exactly down our alley, so to say. We do like to be techy and innovative, and we are, but we do smile because for us this is nothing new. We're doing this since 1998 and are now 25 years down the trend of having a systematic approach. So with that, it obviously helps us a lot. But I mean, bringing it really back to what we do on the floor, we are able to be more accurate in terms of our economic predictions. We are able to process way more information. We can get new information, new data, etc., and we can be more clinical on our risk management, etc. So we are using all of it. And if you don't, we do think you will fall behind. So absolutely crucial.
Thanks, Bastian. I think certainly lots of excitement and innovation, and I agree, that's our world. But maybe just to bring this all to a close, we've spoken a lot. I think we had a bit of a quick swirl around the world. Maybe just as a summary, what is Prescient's sort of house view right now and expectation for the year, for the balance of the year ahead?
Yeah, just a cautious stance in general, I think that's warranted. So if I go back right to the beginning on inflation, we stay optimistic that inflation is going to come down potentially faster than what it's priced for, which is just positive throughout. With that, potentially easier financial conditions, as Reza said, that will definitely open the door for more interest rate cuts than are currently priced. All of that positive, as Henk said, it will then feed through locally as well. So good outlook from that point of view. Before I get too bullish, there's headwinds as well. So the economy slowing down in the second half of this year is a theme to look out for. As we said, we look at the data only. Data doesn't really suggest that yet, that there will be a deep recession, but the data does suggest that there's more cautious stance warranted because the slowdown is more pronounced than it has been previously. And yeah, if I bring it down altogether, as Cesar said, valuations are a crucial factor across asset classes. So it's not just the economic themes and the financial conditions and the sentiment, it's also valuations. So if I bring that all together into like a house view, we generally prefer fixed income assets over equities. We're taking a slightly more cautious stance on the equity side. So US equities, emerging market equities, European equities, all of these we would be underweighting. SA equities, for the given reasons, a little bit of an exception. We still arrive at a neutral, because we have more attractive valuations. If we look into the fixed income space, that's where we're slightly more optimistic. After the strong rally, just a neutral on SA government bonds, but actually a positive view on US government bonds. So becoming slightly more optimistic on fixed income assets across the board. And then, as Conway said, on the credit side, spreads are tight. So that makes us slightly more cautious in that asset class. But we do have to highlight that we are mostly playing at the front end of the curve, and that's the area which Henk pointed out to be very attractive. So with that, we wouldn't want to dismiss that asset class. And last but not least, just the currency view. So quite neutral in terms of where the dollar is going to go against other major currencies. Also reflective of us not taking a stance on the US election or other potential political risk. We think that's vastly covered. We do want to say that we are positive on the rand, because even at current levels, it remains undervalued.
Thanks, Bastian. Folks, just to then close, if I can sort of again just reference each of the speakers and their particular portfolios. I mean, I think we certainly, from a Prescient investment management point of view, like to understand where allocations are going in terms of the industry and the way everybody's placing their client money, whether they're either doing it as an advisor on a direct basis, allocating yourself, or using a discretionary fund manager or a multi-manager. And we believe that our range of funds caters for everybody, that we would treat as our clients, whether it's in the retail or the institutional market. So just as a recap, if I may, from my left, Siyiso runs our Prescient equity fund. We've got equity portfolios both domestically and internationally, and that's run on a systematic basis. I think the way we do things is very interesting and exciting, very different from the fundamental houses, but certainly ability to generate returns well in excess of benchmarks is very exciting. And particularly the domestic equity story is quite compelling at the moment. Reza, similarly, from an opportunity perspective, running our flexible bond portfolios, the Prescient Flexible Bond Fund, I think exciting around the valuations domestically on the bond side. Even though we've had a little bit of a rally, we start to see, on the margin, locals placing a bit more, but certainly the foreigners coming back into the market. That's hugely exciting. We believe there's good value still to be had there. So opportunistically, if you're looking to allocate to equities or bonds specifically, we have collective investment opportunities on both those fronts. On my right-hand side, Henk runs the Prescient Income Provider Fund. There's still very attractive returns, even relative to cash. We know that lots of clients have placed money, in the income space for income provision over time, and clients like to build a multi-asset income portfolio into their construction for income. We know lots of South Africans are fairly more conservative, but in the annuity space, great fund for that. And then, as we've mentioned today throughout the presentation, or the webinar rather, that we have a global income provider opportunity to cater for offshore flows. Rupert looks after multi-asset, both on the domestic side, balanced, and global balanced. I think, we're certainly excited about what those offshore assets mean in the local context, where, as you'll recall, we went offshore early on, but using, hedging strategies to ensure that we are able to benefit from both rand strength and weakness. But the important about the balanced portfolio is we include all of our capabilities in there. So you're really getting the full house exposure, or expertise rather, in the balanced space. And then on Conway's side, we've got the alternatives, which includes infrastructure and renewable energy, as well as our credit portfolios, which have become all important in ensuring that you're able to enhance returns across balanced and income portfolios. So as mentioned, the Prescient Income Plus Fund is our specialist credit portfolio, as well as the renewables and clean energy, which we can incorporate into our multi-asset portfolios. I know a bit of a mouthful, all of that, but just then to end, to say thanks very much for my colleagues for joining me today. I know it was a full house, always fun, but I think nice in that we had everybody in one room for one webinar today, rather than trying to do separate asset classes. We will have a separate asset class review at the end of the year, but folks, this is a nice way for us to provide you an overall summary. We will take some questions, so please, if you do have some, put them into the chat. And then, other than to say thank you for joining us, we always appreciate your time. We appreciate your support for those of you that do invest with us. And of course, if you don't, you know where to find us. All our information is on our website. We've got regular information we send out electronically, whether it's fund specific or our capability documents in all of our presentations, as well as our Prescient Perspective quarterly newsletter. So there's certainly enough we can share with you to give a deeper insight into the way we manage money and obviously how our portfolios have done, which I'm pleased to say from a performance perspective, maybe this is more Bastian's take, but performance across the board, across the house is looking really strong. So thank you to you guys for your efforts, and long may it continue. We've got 6 months to go. Thanks very much, everybody. Appreciate you joining. Thanks, Bastian. That was quite a mouthful, a lot to digest, folks. Thanks very much for joining us. We had a good number of people across the country joining our webinar this morning. Hopefully we provided enough information and insight for you to understand and appreciate how we see the world, and certainly for the next 6 months ahead. So as promised, we said we'd have some questions. So Bastian, I'd like to take the first one and pass it across to you. I think I was quite positive on the South African equity market, as was Yiso, but Somebody has asked the question around, well, there's no growth. We're grey listed, at an elevated PE level. This person has mentioned 23. Is South Africa really attractive? What's your views?
Yeah, Murray, good question. Good first point to take. I think there's a little bit of a misunderstanding. The PE ratio in South Africa is actually at 13, so 23 was for the States. So we are quite attractively valued from a pure valuation point of view. And we also, as we think at Prescient, the way we measure it, quite attractively positioned from a sentiment point of view, because we have a little bit of positive turnaround with load shedding fading out, hopefully, and a positive election outcome. And at the same point in time, we acknowledge that right now emerging markets are still not in favor, still out of favor, not just as South Africa, but as an emerging market asset class in general. So they are two distinct positives. And then speaking about the negatives, we do acknowledge that there are headwinds through tighter financial conditions and those weaker global economic conditions, which we also mentioned in the webinar. So with that, headwinds for sure, a negativity to some degree, but also some positive elements, valuation definitely positive. And with that, we actually arrive at a quite balanced stance, which is a neutral to moderately positive. Just one last comment also on the grey listing, also just because that's in the question as well. We're not too worried about the grey listing. These small political events often don't really drive equity markets over the long term. Remember, a large portion of our company's revenues are generated overseas anyways. And I will also say the grey listing, it must well be in the price. Plus, we are potentially trying to get out of it by June 2025. Whether we manage to achieve that or not is a different question. But surely with the new government, maybe the odds are even higher. So yeah, for us, it's no reason to be negative on SA equities at all.
I can certainly assure you, trying to do business offshore with grey listing is not easy. So I'm sure 2025 and hopefully getting a clean bill of health will help a lot of our advisors to help their clients take money offshore, but let's see. Another question relating to an asset class, property. I know South African property may be sort of underrepresented in a lot of balanced portfolios. The correlations to bonds, do they offer an attractive entry position at this point for investors?
Yeah, again, I have to give a kind of mixed answer, as normally an economist would do. Again, we have a neutral stance. There's headwinds and there's tailwinds. Obviously, interest rate potentially prompt to come down, and that's obviously good for property. One of the factors which we going forward looking will measure in financial conditions, hopefully easing again. That's a positive. From a valuation point of view, property to some degree is undervalued, but we also need to acknowledge that after this very strong rally, which we had over the last 12 months, valuations have actually adjusted. And we track valuations in the property sector also against the bond sector. So our bond market also is very cheap, which on a relative basis makes bonds potentially more attractive than property. So mixed stance, positives and negatives here as well. Not everything in our views is...
While attractive, but relative to bonds, you'd rather take the bond position.
Exactly, yeah.
Okay, great, thank you. Rupert, maybe I've got a question. We've seen some significant news out of the United States just last evening. Reza said in his component or contribution to the webinars that there's lots of statistical noise. Is Biden bowing out statistical noise?
I mean, look at the market reaction today. Absolutely no reaction. I mean, that's what we know. We like to focus on the facts. The facts suggest exactly as Reza said, statistical noise. Nothing happened on the back of Biden pulling out. That's also what you would probably expect. Probably a more continuation of, let's assume Kamala Harris would be the new presidential candidate, then she would probably continue the politics of Biden like for like. But on top of that, we must say that it's not necessarily the most likely case that Democratic candidate wins the election anyway. So with that, very, very muted reaction from markets this morning, and I guess rightfully so. And speaks towards Reza's point that the headlines are not necessarily the driving forces of markets, which is something we at Prescient always say. But I also want to give a quick insight into how we measure political events, because they can drive markets and they can have an impact. And I mean, we've seen it with our election. So the way we do it, we use forward-looking measures of implied volatility, and we then can back out how much uncertainty is really priced for different time periods in this certain asset class. And in this instance, we can look at volatilities for example, the dollar-rand exchange rate, or the US equity market, or the US bond market, and we call that investor sentiment. So how complacent are investors, or how worried are they? And we like asset classes where there's already a lot of worry priced in. So if we look into equity volatility, bond volatility, currency volatility, all of them sit at close to all-time lows. And so you've got a US election coming up. The Democratic candidate just pulled out. The Republican candidate almost got shot. At the same point in time, the market is not pricing any uncertainty. And that obviously is a red flag for us. And we systematically picked it up to an indicator set which tells us, look, you should price for some uncertainty. Right now, no uncertainty is priced, and there's a problem. And that is something which reaffirms our negative stance of US equities.
Okay, thanks for that. Folks, we're coming to the end of it. Just a reiteration around our balance fund and the offshore exposure. We created a sort of, I guess, something of a view that should interest rates get cut in the US, would be dollar weakens and the rand strengthens. The question is around the offshore allocation of the balance fund. What happens there? Would you not see a negative impact on the valuation or the daily price movement of the balance fund?
Yeah, not so much, Murray, because a big portion of our offshore exposure is currency hedge. So we have to go back right to the start. We were very quick to move 45% offshore, but that never meant that we had 45% dollar exposure. We don't want 45% dollar exposure because we do acknowledge that the rand can very well also strengthen, and 45% dollar exposure is too much. Having said that, we do acknowledge that South Africa is just 1% of global GDP and less than 0.5% of global market cap. So you don't want to have a big home bias. With that 45% overseas, that's the right allocation, but not 45% currency risk because our funds are rand denominated. So if we see a lot of strengthening now of the rand after the election, it doesn't hurt us at all because we have locked in that priced-in depreciation of the rand against the dollar already. So we've taken those gains already and accrued them now in a slow and steady way. So the rand strengthening or weakening doesn't really have too much of an impact on our fund performance, which is great. So yeah, that currency hedging bit is really risk reducing and one of the strong points in our investment strategy.
And then one final trick question. Again, back on the back of US cutting rates, what is the best fund you'd put your money in to defend yourself against a rate cut?
Yeah, I think we have already spoken about some of our funds so positively in that webinar. Okay, so where do you want to position yourself if the yield curve is deeply inverted? You get higher rates at the front end than in the back end. Where do you want to position yourself if you have uncertainty around US elections and you basically just want to play it safe? Where do you position yourself if you can get 6% in dollars with a volatility below 1% and almost no downside risk? Well, that's obviously the front end of the US curve. Do we have the right product for that? Luckily, we do. So you mentioned earlier our global income provider strategy. It's a very innovative way we run this strategy, and it happens to rank right at the top across all Morningstar categories. The relevant Morningstar categories have gone across against all the peers. It's 5-star rated by Morningstar. But I think the focus really here is on the process. We run it very, very innovatively, focusing on asset allocation, focusing on a systematic approach, holding more than 5,000 names, almost no downside risk. So I think that's the one strategy. If you want to play it safe for the months to come, for the end of the year potentially, that's where you could really be well positioned. So yeah, please speak to us about that.
Good stuff. Thanks, Bastian. Folks, we've come to the end of it. There are no more questions. Thank you for joining. We appreciate you spending time with us this morning. The recordings will be available. Please reach out if there's anything, any questions or any particular fund strategies that you'd like to know more about. We're available online, or you have our contact details. Thanks for joining, and we look forward to seeing you at our next webinar.